why use superannuation to save for your retirement? Now, this chart is really showing you the tax implications of different structures. The 5 broad structures that you can choose to invest through are your individual names, joint names, in a trust, a company, and in superannuation. And superannuation has 2 different phases. One's the accumulation phase and one's the pension phase. Now let's just look at the tax implications of each of these structures. Now there are other structures. There are the first home savers account, there is insurance bonds, investment bonds. So there are other structures, but these are broadly the 5 main structures that people assess when they're looking to invest money for their retirement purposes. Now, any investment derives either income or capital gain. Now, to explain the difference there, if you think about an investment property, so a residential investment property, that will generate rent, that's the income, or it might go up in value. So a property that you buy for $200,000 might go up in value to be worth $300,000. So that's the capital gain, it going up in value. So from a tax perspective, if you've got an investment in your own name that generates income, and for example, you're earning the average wage, so earning somewhere between $37,000 and $80,000, you'd be paying 30% tax, or if you add the Medicare levy on there, 31.5% tax. So if you earned income, investment income on top of that income, you'll be paying at least a third of that income out in tax. So often we try to focus on paying less tax than 30%. Another alternative might be to invest in joint names. So the thing that happens there is that the income is just split between the 2 of you. So if one of you is still on a marginal tax rate of 30% or more, then there are generally better outcomes that can be achieved. A trust is an effective way to distribute income to a range of beneficiaries. So you can put your investment assets into a trust and you can distribute the income that it generates to a range of beneficiaries. So if you've got a range of children, you can allocate that to, or grandchildren. Or the other one that's effective is to allocate the earnings from a trust to church or charitable organisations that are not taxable organisations. So the income can be allocated to them pre-tax. Because they don't pay tax, it's an effective way of distributing income to church and charitable organisations. So that is sometimes a useful structure. The other structure is a company, but because it has a flat tax rate of 30% and there is no discounting on the capital gain, so if you hold an asset in your own name and it increases in value and you've held it for longer than 12 months, the gain is discounted by 50% before it's added to your taxable income and marginal tax rates applied. Whereas in a company, you don't get that discount on the capital gain. So generally, a company is not the best structure to invest in growth assets. The final structure here is, and really what we're trying to portray here, is that superannuation is a great place to invest in retirement assets. The key reason for that is in pension phase, there is no tax to be paid on any income or capital gains. And when you're over 60 years of age, there's no tax to be paid on drawings. And if you're below 60 years of age and you're drawing money from your superannuation, it's concessionally taxed as well. So superannuation is a great place to hold retirement assets. Now, in accumulation phase, where you're putting money into your superannuation account, the tax rate on earnings is 15%, or on capital gains, if they've been held long, if you've held them longer than 12 months, is 10%. So generally better than the tax rate of someone on the average wage or over the average wage. So that's why superannuation is such a good structure to invest your retirement savings. The 0% tax rate there.